Just want to do a bit of an update in regards to a post I put up the other day. You can see here, in fact I'll just zoom in a bit more so we can see a little bit better. This is bonds, this is a 30-year bond, and it trades within a range. You can see here in December 2017, bonds sold out, touched the bottom of this range, followed by a huge candle, great big green candle right up here after this selling. This was on, let's have a look, the 5th. So day beginning the 7th, 8th of February. Let's jump across to the S&P500 and see what happened on the 8th of February in 2018. And we can see that the 8th of February, 6th, 7th, 8th, here we are, boom. So that was the 8th of February in 2018, and there's another crash here actually, so we'll go back over to the 30-year again, not the yield, sorry, the bonds. Oops. What do I see here? Yep, so there's your first one. Touch the bottom of this range, great big green candle up, and again here, look at that. Came back down, touched the bottom of this range, went to breakthrough, huge green candle up on which day again? 7th of November 2018. Let's go back to the S&P 500 and have a look. 7th of November. Right, so as rates were going down, this was going, 7th of November was here. So this is November. So you can see as rates sold off and then rallied up, it just sent stocks absolutely tumbling on 2 occasions. Let's have a look at the March crash and see if there's any correlation here. 30-year again, prices. See, that was all one big correction here as it rallied up. And then, see with March it was slightly different. It actually hit the top of its range here in February, but then what happened is it basically just gapped down to this price here. It was that severe, it gapped down over a weekend. And then it was, so that was the 14th, 13th, 14th, 13th of February. It's only once it started rallying up here that things had crashed. So let's have a look, where's the 19th? So 18th, 19th, 20th, 20th is there. I'm pretty sure that's sort of around the time the crash started. Let's have a look. March, so 20th, yeah, first day here. First big leg down, 20th. So you can see as it looks as though when rates go down, it doesn't necessarily mean that it's bad for stocks, but what happens is they reverse. You had this big gap down and this huge reversal as bonds started going up, and that just sent stocks absolutely crashing down. We all know how bad March was. You can see the same thing again back in the end of 2018 and the beginning of 2018. There's been other occasions as well. I've not actually even looked at these spikes, but I can reasonably assume we're probably going to get something similar. I mean, there was this zone here, was this September and October 2020. What do we have? Yields, September and October. So there's September, October. Okay, so yeah, perhaps slightly delayed with this one actually. So it looks like the bonds did sell off, hit that peak and then rally back up again. And yeah, that led to the correction. So what we've got this time, we've actually gone underneath and we've just started to turn green just today. So potentially, I don't know, we may bottom, we may spend a day or two down here, but if based on what's happened with the Fed saying that their overnight banking system has failed, I don't know the ins and outs of it, I don't think anybody does yet, but that's potentially not very good. We've got bonds already down here, yields are already on the way up. If we close, we might find this weekend we gap up and then things just get moving, so it's very, there's a possibility that Monday is the day that we're all waiting for, that we get another spike up here like this. It's not saying it will happen, but it's possible. We're certainly going to face some sort of a correction, as it will. If you have a look now at stocks, you can see, you know, a clear sort of topping pattern. By this, I mean we're basically here, And it looks pretty similar as well, you know, this whole slight rolled over and then, you know, slight roll over, and it gapped down on the open on the Monday when that was it. So by all means we could gap down. A sensible correction, to be fair, I've been saying for quite a while, the sensible correction would be the 50-week moving average. You can see we've hit this on a number of occasions. Early 2018 went down to touch the 50-week, and then later it actually went down to touch the 200-week, but you know, we found a bit of support. Periodically we do tend to test this 50-week moving average on a number of occasions. It's held even the way right up here, so even a reasonable correction should see us come, even just above the 50-week, would see us come down to the previous high at 3,400, which is going to be a sizable correction in the S&P. Even if it was, you know, minimal, if it's anything like this, we're going down here, you know, and potentially there's this long-term trend which is just getting bigger and bigger. You know, it's possible we're going to be down here in a couple of weeks. Not to say that is the case, but you know, possible. Anything's possible. Just one to think about.